For decades, this company was the bank that sold coffee, a dividend machine, a growth monster. But look at 2025 and you'll see a giant on its knees. We have a crashed EPS, a PE ratio that makes no sense, and a dragon in China that is eating their lunch. Is the new CEO Brian Niccol the savior? Or is this the beginning of a long, painful decline? Today we analyze Starbucks. We will analyze what they do, their financials, what kind of future should we expect, and finally their intrinsic value. Let's start. Overview. Starbucks isn't just selling caffeine. They sell the third place, that spot between home and work, or at least they used to. Recently, they have morphed into a fast food efficiency machine, but they are trying now to pivot back. First, let's see what they actually sell. They have moved from hot coffee to cold beverages with sugar. Beverages make up around 60% of their sales, and around 70% of US drinks are now cold. These are high margin because ice is basically free. Food makes around 20%. These are breakfast sandwiches and egg bites. This is the attachment item to boost ticket size. And the rest make around 20%. Bagged coffee in grocery stores and merchandise. Next, where does the money come from? North America is the cash cow with 74% of the revenue. It's saturated, so growth relies on price hikes. International is about 20% of the revenue. The China engine has stalled, where the market share collapsed from around 40% to around 10%. And third, their main costs. First, we have the commodities. They buy massive amounts of Arabica beans, milk and sugar. If the global coffee prices spikes, their costs explode. Second, we have labor. Their big expense is the new fast service promise, requiring more staff hours, which is currently crushing their margins. But in simplicity, they are a multinational coffee shop. Now let's look at the numbers. Financials. The numbers, in all honesty, are ugly. Right now, this company is valued roughly 100 billion. But here's the red flag. The PE ratio is sitting at a massive 52 times. That is a valuation usually reserved for tech rockets, not coffee shops. Even if you look at the forward PE ratio, which relies on optimistic guesses for the next year, it is still sitting at 35 times. You are paying a huge premium today for a recovery that hasn't actually happened yet. This isn't because the stock price rocketed to the moon. It's because their earnings fell off a cliff. We will get back to this later. Investors are still getting paid to wait, with a dividend yield of around 3%, but clearly Wall Street is nervous, because the forward EPS is lower than their current dividend. Short interest has crept up to 4%, which is high for a blue chip company. It tells us that a lot of smart money is betting that this turnaround fails. When we zoom out and look at the past 10 years, the story gets even clearer. For a decade, revenue was a straight line up, doubling from 2016 to today. But growth has hit a wall. In 25, revenue growth slowed to a crawl at just around 3%. And the only reason it's positive is because they keep raising prices, not because they're selling more coffee. The real disaster is on the bottom line. EPS used to be the thing of beauty, climbing steadily to a peak of almost $4. But in 25, the number crashed to around $1.50. That is basically an over 50% haircut in profit in just 1 year. Why? Because they are spending a fortune trying to fix the stores and dealing with a massive collapse in China. This spending is draining the cash register. Free cash flow, which used to be reliable enough to buy back billions in stock, is now under serious pressure. And you see the damage most clearly in the margins. Starbucks used to boast an operating margin of nearly 18%, the envy of the restaurant world. Today, it has collapsed to just high single digits. They're running harder just to stay in place. Finally, we have to talk about the balance sheet. They're carrying a heavy load of 23 billion in long-term debt. That is a massive amount of debt. Even worse, their return on invested capital, the measure of how good they are at using your money, has dropped from a stellar 25% about 10 percentage points in total. They are just spending more to get less, and that is a dangerous trend for any business. Now let's look at the future, if they can recover from this. Future. So, where are they heading? This feels like the movie where the hero has 3 seconds to cut the wire. That hero is Brian Niccol. Wall Street loves him because he's the Chipotle fixer. He took that company from a crisis to an 800% stock gain. His plan here is simple: make Starbucks human again. Ceramic mugs, 4-minute service, and no more factory vibes. Will it work? Only future can tell. But if somebody could do it, it would be Brian Niccol. There is a dark side hiding in the fine print. First, we have China. They are effectively surrendering, planning to sell 60% stake of that business. Why? Because they are getting crushed by Luckin Coffee, which sells lattes for $1.50 while Starbucks charges $4. It's a global problem. I saw it personally here in Bangkok. I paid $4.50 for a latte at Starbucks, while the shop right next door sold a great one for $2. Now sure, the other place wasn't winning any design awards. It was just the basic chairs and tables, but it functioned. You could sit, you could work, and the coffee was good. Starbucks is charging you 130% premium essentially for better decor, but in this economy, is a slightly nicer chair really worth paying double? Then there's the money. Starbucks has a negative equity. They technically owe more than they own, because they borrowed billions to buy back their own stock. If earnings don't bounce back fast, that dividend check you love could be on the chopping block. Then there's the new Green Apron service plan that requires more staff. That means higher labor costs are permanent, and those huge profit margins of past might be gone forever. Financially, future isn't looking too good for Starbucks. Based on history, if there was one person who could change the course, it would be Brian Niccol. Now let's stop guessing and start calculating exactly what this business is worth today. Intrinsic value. Finally, let's put a price tag on this. Right now, the forward EPS sits around $2.4. Analysts are projecting massive growth, betting that the earnings will bounce back by 10 to 25% per year as the turnaround takes hold. I think they're pointing to 23 when the earnings hit peak of $3.60 and saying, see, we can get back there. But let's look at the reality. Their current trailing earnings are just $2.12. That's a 40% drop from the peak. Sure, I can see a recovery happening if the margins snap back to normal, but I'm not betting my money on it. Why? Because their only real moat right now is that they are big and recognizable. If I saw a Luckin Coffee next door with similar setup for half the price, I would switch in a heartbeat. And in this economy, I'm pretty sure I'm not alone. In my mind, the best scenario is that they simply stop bleeding and return almost to normal. The worst case is they keep losing market share to cheaper rivals. So I'm conservatively estimating 8% growth for the next 5 years as they stabilize, and then slowing down to 4% after that. And as always, I demand 12% return on my money. Over the last decade, Starbucks has traded at a premium PE roughly between 20 and 40, but the world has changed. Given the disaster in China, the heavy debt load, the crushed margins, and the very real risk of a dividend cut, they do not deserve that old growth king premium anymore. I will apply a terminal multiple of 20. With these numbers, we arrive at the intrinsic value of approximately $46 per share. And remember, this is not financial advice. I'm not a financial advisor. Do your own research before investing. So here's the bottom line. Starbucks is a legendary brand, but right now the ship is taking on water. The math is scary. Their forward EPS and free cash flow are currently lower than their dividend payout. In plain English, they are paying out more cash than they are bringing in. That usually ends with a dividend cut. If there is a glimmer of hope, it's Brian Niccol. He fixed Chipotle and he's a legend for a reason. But I worry he's fighting a war he can't win. With Chipotle, you have endless food variety. With Starbucks, you are selling coffee. And be honest, could you tell a difference between Starbucks black coffee and a generic one in a blind test? Probably not. People are forgetting that coffee is a commodity. Customers will swap brands in a heartbeat to save couple bucks. In my mind, the only way Starbucks wins is if they make their store so incredible, such a creative, comfortable paradise that I happily pay a 100% premium just to sit there. Right now, they aren't there. To me, Starbucks is grossly overvalued. I am not buying at these prices. And frankly, I struggle to see what the bulls are seeing here. The whole cafe business should be downgraded from quality blue chip to just a blue chip. But what do you think? Was I too harsh? Can Nicole pull off another miracle? Let me know in the comments. Also hit the like and subscribe for more. And as always, do not lose money and safe travels.